Welcome to Workbook Solutions Chapter 1. This video corresponds with videos 1 and 2 of my lecture series. If you have the workbook, referencing it as I walk you through the problems may help. If not, no worries, the problems in their entirety will be presented. Let's start with the Athens upholstery shop example. This problem should be on page 8 of the workbook. If you don't have it, I recommend pausing the video to read through the problem before we begin. Taylor initiated his business by depositing $20,000 in the company checking account. If you turn to page 10 as of the recording of this video, you'll find a table for recording your increases and decreases in the Athens upholstery shop accounting equation. If you don't have the table, don't worry. You may copy this one or just follow along. How will this deposit be reflected in the accounting equation elements? Remember that Taylor's new business is a separate economic entity from Taylor himself. This fact is indicated by the business having its own bank account. The company's bank account balance is increasing as a result from an increase in the company's cash. This money was contributed by Taylor, the owner, meaning the corresponding offset will be an increase in owner's capital. Think of it in this manner. Of the $20,000 just contributed by Taylor to Athens Upholstery Shop, Taylor has a claim on all of it. If Taylor's former boss offered him his old job with more money and better accommodations, and Taylor accepted the offer and closed his business right now, he'd be entitled to all $20,000 of his contribution. Next, let's consider the $6,000 and $2,000 of advertising. Here we have a total $8,000 cash disbursement, decreasing cash. Where's the other side of this transaction? We're consuming a service from an outside party, so that'll be recorded as an expense. Specifically, an advertising expense. Taylor also purchased sewing machines for $4,000 and other tools and equipment for $3,000. The sewing machines will last for about 5 years before needing to be replaced, while the other tools and equipment will do so for perhaps 3 years. For the sewing machines, unless a transaction states that it was a credit purchase or was purchased on account, it's safe to assume it is a cash purchase, meaning that cash is decreasing by that $4,000. This is not an expense because we're not consuming the assets, just acquiring them. Consequently, we have an increase in the equipment asset on the same side of the transaction. The $3,000 in tools can be analyzed in the same manner. Cash is decreasing for $3,000, and we have a corresponding increase in equipment assets. Before we go any further, let's focus on the life expectancies of those assets, 5 years for the sewing equipment and 3 years for the tools. We saw the first definition of an expense with the advertising expenditures, that is, the consumption of a service from a third party. Remember the second definition, the company's consumption of its own assets. As Taylor uses these equipment assets, he's consuming their useful lives. So what's the implication at the end of the first year? Answer: Taylor needs to expense the portion of these assets that he's used. Based on that previous discussion, we're going to have a decrease in our equipment assets for the portion consumed, and a decrease in equity via an expense for that consumption. What might the amounts be? We know that the sewing equipment cost $4,000, and it will last for 5 years. Based on that information, how do we figure the annual expense? Divide the amount by the expected life, and we'll expense $800. Follow the same process for tools and equipment. Take the $3,000 amount and its 3-year life, then divide out the quotient to get $1,000. As for what type of expense these qualify as, they'll be depreciation. Please note that depreciation is defined differently for accounting purposes than most people think. When many people think or hear of the term depreciation, they think of a decline in market value. For instance, if you buy a new car, as soon as you drive it off the lot, it depreciates, losing a third of its value because it's no longer new. Such is not the concept for accounting. In financial accounting, depreciation just means we're expensing the cost of an asset in the period benefited by its use. Doing so upholds the matching principle discussed in my introductory lecture. Now, let's consider that at the end of his first year, Taylor had received $80,000 in cash from customers. Taylor is also owed another $2,500 from customers who weren't required to pay cash upon delivery, but must pay within 30 days. In other words, Taylor is owed $2,500 for work he's already completed. As for the $100,000 of cash received, that'll be an increase in cash assets. Taylor has earned this money by serving his customers, so we'll have an increase in equity via revenues. Now for the $10,000. Taylor has earned this money, so it's also an increase in equity via revenue. However, he has not yet received payment, so we don't increase cash. Rather, Taylor has a right to receive this cash amount in the future, so the asset increasing is accounts receivable. Next item. Taylor's checkbook reveals that he paid for the following expenses, quote unquote. Let's go through these items one by one and put them on our schedule. First off, the upholstery fabric. Taylor bought it, but did he use all of it immediately upon purchase? He did not, so it's not an expense. The fabric by itself is an asset, a company resource that provides a benefit either right now or in the future. Consequently, we increase supplies for the asset acquisition. Bear in mind, these items were taken from the company's checkbook, indicating that Taylor paid cash instead of purchasing via credit. Consequently, Taylor should decrease the cash asset for the amount dispersed. Other supplies can be analyzed in the same manner. The purchase by itself is just the acquisition of a resource, so increase supplies asset, and decrease cash for the amount paid. Taylor paid $9,500 in wages to a part-time assistant. Cash was paid out, so we have a decrease in our cash asset. Remember our economic entity principle. The business is a separate and distinct entity from its owner, but it's also just such an entity from its employees. That is, a business does not own its employees, so that assistant is effectively a third party. In other words, Athens Upholstery has consumed a labor service from another entity, meaning we have a decrease in expense, or a decrease in equity via expense. Specifically, we have a wage expense. Now for the rent. We have a decrease in cash for the amount dispersed to the landlord. Again, we're consuming a service of sorts from someone else. In this case, the landlord is letting Taylor utilize his building asset in exchange for compensation. So we have another equity decrease via expense. In this case, we have rent expense. At the start of the year, Taylor paid $3,200 for a 2-year insurance contract. Once again, that payment constitutes a decrease in cash. Upon payment, that insurance company owes Athens Upholstery Service 2 years' worth of insurance coverage. Just like someone owing us cash as a receivable, that service owed to us is an increase in an asset. But which one? When someone owes us a service, we have a prepaid asset. That was at the beginning of the year. As of year end, Geico or Allstate or Farmers no longer owes Athens Upholstery Service 2 years of coverage. It just owes 1, meaning 1/2 of that 2-year contract has been consumed. So we have a decrease in the prepaid asset and a decrease in equity be an expense. The amount will be $1,600. This is the $3,200 acquisition divided by its 2-year life. We'll call this item an insurance expense. 2 items left. The $2,500 paid for utilities will be a decrease in cash and a decrease in equity via utility expense. Same again for miscellaneous expenses. Decrease cash and decrease equity via expense. Most companies have an expense account called miscellaneous expenses. These are for obscure items that don't occur frequently. Taylor's utility bill for December has not yet arrived, but he estimates that it will be around $320. Just like the previous utility bill, this is a service being consumed from a utility company, so we decrease equity via utilities expense. Athens Upholstery hasn't yet paid this bill, so we can't decrease cash just yet. Rather, Taylor estimates that he owes this amount as of the end of December. When we owe another party something, we have a liability. In this case, an increase in accounts payable. Taylor keeps some upholstery fabric in stock for customers who don't want to wait for specially ordered fabric to arrive. At the end of the year, $14,000 of the fabric purchased during the year is still in stock. This statement references the upholstery fabric purchased for $40,000 at the beginning of the year. This information allows us to infer how much of that fabric was used or consumed during the year. That is, we're determining our decrease in assets for fabric supplies used and the corresponding decrease in equity for the expense. So what's our amount used? Hint, it's not the $14,000. Instead, it's the difference of the fabric purchased less the fabric remaining, or $26,000. If you don't quite follow, imagine this. We have our boxes of upholstery fabric that Taylor bought in January, seen right here. At year end, here's the $14,000 we have left. What we have left is not what we used or expensed. The fabric no longer present is what we used. Putting this into our table, we'll have a $26,000 decrease in supplies within our assets and a $26,000 decrease in equity via fabric expense. The same methodology applies to the $2,300 of other supplies on hand, referencing the $10,000 of supplies purchased. Subtract from that the amount we have left, and the difference is how much we've used. On that bottom line, put the decrease of supplies used as well as the decrease in equity via supplies expense. We can verify that our equation remains balanced by summing the increases and decreases in each column. Our assets total to $66,400. Sum our liabilities and equity, and you'll get the exact same amount. Lastly, how much profit did Taylor make his first year in business? Do you think it was a good idea for him to open his own shop? How can we answer this question? Remember how profit is calculated. It's the difference between our revenues and our expenses. We have the sum of those two items right here. Take their difference, and Taylor has a net income of $46,080. As for whether opening the shop was a good idea, Taylor made a little less than at his previous job. but he was able to turn a profit close to his old salary. Considering most businesses don't make any money at all their first year, he actually did very well. He and his business likely have a bright future. If you turn to page 11 of your workbook as of the time of this video, you'll see something like the following list of transactions and a table. Based on the previous example, see if you can work out each item's impact on the accounting equation. Starting with the transaction on November 1st. Chris Smith deposits $25,000 in a bank account in the name of AthensNet. Here we have an increase in cash assets and an increase in equity via owner's capital. On November 5th, AthensNet paid $20,000 for the purchase of land for a future building site. Now, cash assets are decreasing, but land assets are increasing. November 10th, AthensNet purchased supplies for $1,350 and agreed to pay the supplier in the near future. AthensNet is acquiring a resource, specifically an increase in supplies assets. Cash isn't decreasing because AthensNet hasn't paid. AthensNet has an obligation to pay in the near future, so there is an increase in liabilities. November 18th. AthensNet received cash of $7,500 for providing services to customers. When cash is received, cash assets will increase. AthensNet earned this money by serving its customers, so we have an increase in equity via revenues. November 30th. AthensNet paid the following expenses during the month: wages, rent, utilities, and miscellaneous. This one's easy, right? Our expenses will decrease equity for each of their respective amounts. And will decrease cash for the sum of those amounts. November 30th. AthensNet paid creditors on account $950. Here, AthensNet is paying part of the liabilities owed, so we decrease cash for the disbursement and reduce liabilities for the amount dispersed. Another November 30th transaction. Chris Smith determined that the cost of supplies on hand at the end of the month was $550. Supplies on hand at the end of the month tells us this is what's left, not what was used. To determine how much was used, we take the $1,350 purchased on November 10th, subtract what is left, and supplies tabulates out to $800. That's the amount by which we decrease supplies. Since we're consuming an asset, we decrease equity with supplies expense. Last transaction for November. Chris Smith withdrew $2,000 from AthensNet for his personal use. Decreased cash for the amount dispersed, and decreased equity via owner's drawings. To verify that our equation is balanced, sum each column. Total assets comes out to $26,450. Liabilities plus equity totals to $26,450 as well. Let's try another example. We'll build on this one by previewing financial statements afterwards. For now, consider Ron's Lawn Care on page 12 of your workbook. If you don't have the workbook, screenshot or pause this video right now if you'd like to work through on your own, then check your efforts. On page 13, you'll find the table for the accounting equation. Transaction 1. Ron began a lawn care business in May by depositing $800 in a bank account. Cash increases by $800, as does owner's capital. Transaction 2. Ron purchased lawn mowers and other lawn equipment on account for $1,000. The acquisition of this equipment is an increase in the aptly named asset account. On account tells us this is a credit purchase, so Ron didn't disperse the cash just yet. He has an obligation to do so in the future. So we have an increase in accounts payable, our liability. Transaction 3. Ron paid cash for supplies, $50. Decreased cash and increased the supplies asset. Remember, it's not an expense until we consume the asset. Transaction 4. Ron performed lawn care services for credit customers and billed them for $700. Ron has earned this money by doing the work, so we increase equity via revenues. These are credit customers, so Ron's not getting the cash right now, but he has a right to receive it in the future, so the asset we increase is accounts receivable. With transaction 5, Ron receives that cash, so increase cash for what was received, and now that accounts receivable is no longer collectible, so that gets the decrease. Transaction 6. Ron paid $1,000 for the lawn equipment purchased in transaction 2. Decreased cash for the disbursement, and reduced liabilities since Ron is satisfying that obligation with this payment. Transaction 7. Ron paid for an advertisement at a local newspaper for $150. You see the word paid, and you know cash is being dispersed. So decrease cash. Ron's lawn care is utilizing a service from the local newspaper, so he has a decrease in equity via advertising expense. Transaction 8. Ron performed services for cash customers and was paid immediately. Cash was immediately received, so cash increases. And Ron's lawn care earned this money by doing work for the customers, so increase equity via revenues. Transaction 9. Paid wages to a part-time assistant for $85. Decrease cash for the disbursement, and decrease equity via wages expense. Transaction 10. Ron performed lawn care services for credit customers and billed them $600. Ron has earned this money by doing the work, so we increase revenues. The term credit customers indicates that they haven't paid just yet, so we increase accounts receivable as opposed to cash. Transaction 11. Ron received an invoice from Gas & Go for fuel purchased on account during May for $110. On account indicates this purchase was with credit, so we increase liabilities. Now, fuel is obviously a resource or an asset, but there's a constraint in accounting known as materiality. Materiality states that all items that are reasonably likely to impact financial investors' decision-making process must be recorded and reported according to GAAP. According to GAAP, only the portion of the gasoline that's been consumed should be expensed. The remainder should be listed as an asset. But since $110 is a pretty small amount, and all the fuel in the tank will be consumed eventually, probably within the next week at most, let's just expense it all right now. We'd say that the amount is immaterial, so we can bend the rule that would prevent us from expensing it. Transaction 12. At the end of the month, Ron withdrew $100 from the business for his personal use. Decrease the cash asset, and decrease equity via owner's drawings. Now, total our columns. Assets will sum to $2,185. Liabilities and equity will sum to the same amount. Based on this information, specifically the column totals, We can then build the company's financial statements. Don't fret too much about the financial statements just yet. They'll be covered in more detail in the next few lectures. Let this example serve as a preview. Turn to page 14 of the workbook to see a template of sorts for the financial statements like the one seen here. First, we build the income statement. List your revenue total, then do the same with all the expenses. The difference between our revenues and expenses will be a company's net income or profit. After the income statement, we build the statement of owner's equity. Since Ron just began operations this month, beginning owner's capital will be $0. We'll add the $800 contribution Ron made to get the business going. We'll also add the net income calculated on the income statement. Subtract out Ron's withdrawal at the end of May, and we have the month's ending owner's capital. Lastly, we'll do the balance sheet. We'll list each asset's account balance and sum their total. Put accounts payable under liabilities and pull down ending owner's capital from the statement of owner's equity. Those two will total to $2,185, the same amount as our assets. The balance sheet verifies that the accounting equation is balanced. Total assets equals total liabilities plus equity. There's one more financial statement of which you should be aware, the statement of cash flows. Remember that net income is calculated on an accrual basis, so a company's net income is not likely the amount of cash it has at its disposal. The statement of cash flows provides that information. More specifically, this statement elaborates on from where a company's cash came and how it was used. A statement of cash flows will typically be presented in a format similar to this one. It'll have three sections: a cash flows from operating, investing, and financing section. You'll determine the cash provided or used by each section and sum of the net cash inflow or outflow. Add that amount to the period's beginning cash balance, and the calculated ending cash balance should match that of the cash account. For now, don't worry about how this financial statement is made. I only want you to understand what is contained within each section of the statement. The operating section contains items relating to the production of revenues and expenses. If a cash flow stems from or results in a revenue or expense, it's an operating activity. Investing activities pertain to the acquisition and disposal of long-term assets, like equipment, land, and buildings. Note that this section is not just for their acquisition, but also their disposal. If and when Ron sells this mower on the used market, the cash inflow from that disposal will also be an investing activity. Finally, the financing section is for transactions relating to debt and the owner's capital and drawings accounts. Hopefully that made sense. But let's work through this example problem just to be certain. You can find this information on page 16 of the workbook. Let's examine each transaction and determine if it affects cash. If it does, ascertain whether it increases or decreases a company's cash amount and to which section of the statement of cash flows it'll go. June 1st. Nina Nico invested $130,000 in a company in exchange for ownership capital. Does this transaction affect cash? Yes. Is cash going up or going down? Up. Now, since it does affect cash, where does it belong on the statement of cash flows? This transaction impacts Nina's owner's capital account, so it'll be a financing activity. June 2nd. Nina's company rented a furnished office and paid $6,000 for June's rent. This one also impacts cash, but cash is going down. Rent will be an expense, so this one is operating. June 4th. The company purchased $2,400 of equipment on credit. No cash is flowing with this one, so it can't be categorized on the statement of cash flows. On June 6th, the company paid $1,150 cash for the month's advertising on the opening of the business. This one will have a cash impact. Cash is going down. Advertising is an expense, so this one is operating. On June 8th, the company completed maintenance services for a customer and immediately collected $850 cash. This one does affect cash, causing it to increase. This money is received for servicing customers, so it's a revenue, making it an operating activity. June 14th. The company completed $7,500 of maintenance services for City Center on credit. This one doesn't impact cash, so we can't categorize it on the statement of cash flows. June 16th. The company paid $800 for an assistant's salary for the first half of the month. The word paid tells us this is a cash flow in which cash decreased. Since paying our employees constitutes a wage expense, this flow is an operating activity. June 20th. The company received a $7,500 payment for services completed for City Center on June 14th. This one does have a cash impact. Cash is going up. What happened on June 14th? Nina's company did work for a customer earning revenue. No cash was received at that point, so we couldn't categorize it on the statement of cash flows. But since the cash being received ties back to the production of a revenue, we'll put it on the statement as an operating activity. June 21st. The company completed $7,900 of maintenance services for Paula's Beauty Shop on credit. No cash is being exchanged, so we can't classify it on the statement of cash flows just yet. On June 24th, the company completed $675 of maintenance services for Build It Coop on credit. This transaction is the same scenario as on the 21st, just with a different company, so it gets the same answers. June 25th. The company received a $7,900 cash payment from Paula's Beauty Shop for the work completed on June 21st. This one harkens back to the credit sale just 2 transactions ago. The cash wasn't paid then, but it's being paid now. Cash is going up, and since this payment stems from the production of revenue, it is an operating activity. Last little bit. On June 26th, the company made a payment of $2,400 in cash for equipment purchased on June 4th. Cash is being affected, going down for the disbursement. That June 4th transaction was the acquisition of a long-term asset, making this one an investing activity. June 28th. The company paid $800 cash for an assistant's salary for the second half of the month. This is a perfect copy of that previous salary payment. Cash is being impacted going down. This payment is for a wage expense, making it an operating activity. June 29th. The owner withdrew $4,000 for personal use. Cash is going down. This one relates to owner's drawings, so it is a financing activity. June 30th. The company paid $150 in cash for the month's telephone bill. Cash is going down. This one is for a utility expense, making it an operating activity. Another one on June 30th. The company paid $890 in cash for this month's utilities. This one is identical to the one above, except it's probably for electricity and/or water. Nonetheless, cash is going down, and this is another operating activity. That's most everything in this chapter's section of the workbook. There are a few more problems I'd like you to try on your own if you do have the workbook. I'll make the solutions available online. If you don't have it because you're not in my class, I thank you for watching this video anyways. I hope it brought some clarification and understanding of the material. Please leave any questions or comments below, and I'll see you next time.